Good morning, everyone, and welcome to Julius Baer's Moving Markets podcast. It's Monday, the 23rd of March, and my name is Helen Freer. I'll be talking, first of all, this morning to Bernadette about the latest market news and what's coming up this week. Then we'll hear from our Chief Economist, David Kohl, to get his latest thoughts and expectations in terms of monetary policy after the central bank super week last week. And then, as usual on a Monday, I'll be speaking to our Head of Technical Analysis, Mensur Pocinci. So that is all coming up in a few minutes, but let's get started with a wrap-up of the market news first. Good morning, Bernadette.
Good morning, Helen.
And let's start with the latest headlines from the war in Iran then, as that's definitely what's driving sentiment at the moment. We had an ultimatum from President Trump on Saturday, didn't we?
Indeed, we did, Helen. And having said only on Friday that he was considering winding down military operations and suggesting that responsibility for policing the Strait of Hormuz would be transferred to other countries, on Saturday night, he threatened Iran that he would obliterate their power plants if Tehran didn't fully reopen the Strait of Hormuz within 48 hours. So we're obviously still within that period. Iran responded by warning that it would target US infrastructure in the Gulf, including energy and desalination facilities, if Washington were to carry out this threat. This is obviously raising fears of mass disruption in a region that's very heavily dependent on desalination for drinking water. So Reuters reports that such plants use seawater to meet more than 80% of drinking water needs in the United Arab Emirates and 50% of the water supply in Saudi Arabia. Iran's Speaker of the Parliament also warned yesterday that financial entities supporting the US military budget were legitimate targets and that buyers of US Treasury bonds were purchasing a strike on your HQ and assets, to quote. And in a sign that Iran's not giving up on the fight, the Revolutionary Guard said yesterday that the Strait of Hormuz will be completely closed and will not be opened until their destroyed power plants are rebuilt. So it's still very much an ongoing story there, Helen.
Okay, and this news over the weekend followed a bad day for markets on Friday. US stocks had a volatile day and the main indices all closed lower, didn't they?
Yeah, that's right, Helen. The Dow Jones Industrial Average lost around 1% on Friday. The S&P 500 fell 1.5%, and the Nasdaq Composite closed more than 2% lower. Even the small cap Russell 2000 fell. That was more than 2%, and it slipped into correction territory. So in other words, a 10% decline from its latest high. And in fact, at their lows of the day, the Dow and the Nasdaq also traded in correction territory, but they ultimately closed shy of that 10% threshold.
And it wasn't just stocks selling off, was it?
Oh, no. Bond markets have also been impacted amid concerns about inflation and the prospect of higher interest rates. US yields are perched at their highest in months after a third straight week of bond losses, Helen. So short-term notes were leading the rout last week. The two-year Treasury yields climbed 4 basis points to 3.94%. Those on the benchmark 10-year rose by 3 basis points to 4.41%. Elsewhere, silver fell for a fifth consecutive day. Gold is currently trading down. It was around $4,333 an ounce as I started writing this earlier, Helen. And the last time I looked, it was in the 4,200. So prices are moving so fast, it hardly feels like it's worth quoting the actual levels. In response to this latest escalation in rhetoric, the oil markets have been slightly more muted. Brent stayed volatile throughout the Asian session this morning, fluctuating between gains and losses. They've both surged, Brent and WTI, more than 70% this year. And the last I looked, Brent was trading around $113 a barrel, Helen.
And what about in Asia so far today? What are we seeing there?
Well, all of the main indices lower, Helen. Japan's Nikkei and Topix both down more than 3%. South Korea's Kospi down more than 6.5% last time I looked. And meanwhile, the South Korean won has weakened to its lowest level, trading at 1507.75 against the dollar. The Hang Seng is off roughly 4%, and the China's CSI 300 down 3.5%. So negative for all of these markets.
All right. Now, apart from obviously following the latest developments in the Middle East, what else should we be looking out for this week, Bernadette?
Well, if anyone is actually looking through the fog of war, we've got the global flash PMIs for March tomorrow. They'll cover the period roughly up to the end of last week, so they will be heavily influenced by developments in the conflict. We've also got inflation indicators from the UK, Japan and Australia. On Wednesday, we'll get the German IFO survey. That should give us a read on sentiment. And on the same day, Christine Lagarde will be speaking, so that speech will also be closely watched. And finally, at the end of the week, we'll get the final March reading from the University of Michigan US Consumer Sentiment Survey. Meanwhile, the European Commission President Ursula von der Leyen is in Australia with her Trade Commissioner Maros Sefcovic. They will be visiting Canberra in anticipation of signing a free trade agreement with Australia. It's by no means certain, but the deal, if concluded, will be the third by the EU this year, following others with Mercosur and India. And finally, Helen, looking to the day ahead, hardly need to say futures are pointing to a lower start to the trading week, Helen. That's it from me.
Okay, thank you very much, Bernadette, for the detailed roundup to start the week.
Thanks for having me.
Now, I'm delighted to welcome David Kohl, our Chief Economist. Good morning, David. Welcome back to the podcast.
Good morning, Helen.
So, central banks. Let's start with the Fed, who met on Wednesday last week and kept rates on hold. Jerome Powell commented that surging oil prices could cause trouble in terms of inflation expectations. Your thoughts on this, David, and what you expect in terms of Fed policy going forward?
Well, yeah, that's of course the one which had been expected. So Jerome Powell tried to be here, showing a hawkish attitude to signal to financial markets, basically, that central banks and the Fed included is ready to react to any inflationary shock which might arise from higher oil prices. And the interesting thing about the part you quoted, Helen, is that when the Fed is actually aware and acknowledges this risk, then probably the risk that inflation expectations indeed become de-anchored are less of a risk. So in this context, probably we can conclude that the Fed here did everything correctly in terms of calming markets, that this geopolitical event, that this oil price surge here is not triggering a stagflationary backdrop. But of course, that was expected. Central banks are acknowledging that, and that's probably the best they can do in this challenging environment.
And rising energy prices affecting inflation expectations is obviously a topic for all the major central banks at the moment, including the ECB. So they also kept rates on hold last week, and markets are now pricing in more than 2 hikes by the ECB over the rest of this year. What's your view on this?
Yeah, the ECB had been particularly hawkish, and one explanation why they look here rising oil prices as really a challenge is when we look at their published oil price projection. This is not only quite aggressive in terms of where oil prices will rise in the next 2 quarters, but their assumption is really that oil prices will stay high for the foreseeable future. And of course, when you take this seriously as a central bank, then you have to be here a bit more hawkish and signaling more readiness to hike rates as well, to basically counter these arguments. Another point which Christine Lagarde made in her press conference is that indeed the ECB is starting from a point where monetary policy is basically neutral or probably even supportive. So from this point of view, there is room to hike rates and not basically to be entirely negative for the economy. So rates would rather move to a neutral level. And this, of course, makes it quite a wide range of possibilities for the ECB to react to this oil price surge, to these inflation expectations, which we have seen there. We think that once in a year's time, so talking about this horizon, once really here oil prices calm, and that's our central assumptions which we have, that also for the ECB it will not be necessary actually to hike rates going forward because inflation will also then level off. And in particular, the inflation, the oil price-driven inflation will actually calm going forward.
Okay, so there were actually 14 central bank meetings last week, so we can't talk about all of them, but maybe lastly you can share your thoughts on the Bank of England and the Swiss National Bank. Again, both kept rates unchanged. Is this, with so much uncertainty at the moment, given the Middle East conflict, central banks are trying to stay calm and not react too quickly?
Yeah, that's definitely the case for the Bank of England, which is more in the position like the Fed. So quite high interest rates. They are quite keen to go away from that. So cut rates, ease monetary policy. And they said, well, with this uncertainty, with this inflationary risks, we wait a bit longer. So that had been the case here. For the Swiss National Bank, a bit different angle here. First of all, inflation expectations are low in Switzerland and less of a risk than in other regions, than other jurisdictions. But the Swiss National Bank have the problem that in such a crisis, even when it's inflationary or it's triggered by high oil prices, the Swiss franc appreciation causes some issues for the economy, for monetary policy. So they shifted quite explicitly to their attitude or to the target that they want to intervene, that they will intervene. So the signal here, the policy instrument, is not really to do something on interest rates, but rather on the intervention side, because this geopolitical event is here in the center of interest. So these are the two central banks, probably just to name just another one when it comes to last week. The RBA hiked rates in contrast to the trend. That was not only because of the political events, it was indeed also driven by a quite strong domestic economy and inflationary pressures there.
Great. Thank you very much for joining me this morning, David. Great to get a roundup from you on the podcast today.
I thank you for having me, Helen. Thank you very much.
And for those who'd like to hear more on the topic of central banks, Bernadette sat down with Dario Messi, our head of fixed income research, at the end of last week, and they talked about how central banks are responding to the current geopolitical situation, and importantly, what it all means in terms of positioning in the fixed income space. So this is all in our latest View Beyond podcast, published as usual over the weekend on this channel, Moving Markets, and it's called Central Banks Response to the Energy Crisis. And now, lastly, over to you, Mensur. Good morning.
Good morning, Helen.
So, as we've talked about a bit already then, equities have continued to correct. Last week, the S&P 500 fell below its 200-day moving average. How significant is this?
Yes, from a technical point of view, it is quite significant. So this is a very strongly followed indicator, very wisely, and it indicates basically that the trend here, the steep uptrend, has basically shifted, and that equity markets are no longer here in a steep uptrend.
The Hang Seng was one of the first indices to fall below its 200-day moving average. How has it behaved since then?
Yes, here this is quite disappointing. So the Hang Seng was the first one to drop below its 200-day moving average in early March. Then it moved slightly sideways, and today it has broken down to new lows. So this is a slightly bearish signal and indicates maybe here some weakness on a relative basis. What is important here to add when we look back at the S&P 500 is that the S&P 500 has traded above its 200-day moving average for more than 40 weeks. So it was a quite strong uptrend. And yes, the trend has weakened, but a bit counterintuitively, when we look back historically, what happens after a long uptrend in equities when they break these 200-day moving averages, we see that the forward returns are actually bullish. So in the S&P 500, the average 12-month forward return is about 9%. So this means for us that over the next few days, we are looking here maybe for some panic bottom signals in equity markets where we see excessive bearish sentiment.
It's also interesting, Mensur, that defensive sectors have actually been underperforming in the current correction. What do you make of this?
Yes, this is quite surprising for many investors. So when we look at the month to date returns, so since the conflict started, we see that actually defensive sectors have been underperforming. And we would view this maybe as a long-term signal that they still remain in a secular underperformance cycle. So maybe this adds a bit to the evidence that equities, yes, are in a short-term correction right now, but that the secular trend of equities is still intact. And that's why investors are not rushing into defensive sectors at this current short-term setback.
All right. Thank you very much, Mensur. Really interesting, as always.
Thank you, Helen.
So that is all for today. Thank you again to my guests and thank you all for tuning in. Don't forget to subscribe to the show if you haven't already, and do join us again tomorrow when Bernadette will be back, but as your host, and she'll be talking to more of our colleagues about what is moving markets. Have a great start to the week, everyone, and bye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.